Risk. It's a horrible word, nobody likes it, but in investing, it's important because risk is the flip side of reward. If there was a way to invest and get great returns with zero risk, everybody would do it, everybody'd be rich, but in that case, then no one would be. So risk is an integral part of investing, but you can manage it. So how should you do that? How can you reduce risk to a level that you're comfortable with and yet still, hopefully, attain the returns that you want? I reckon there are 3 factors to reducing risk consistently over time. The first is diversification, which simply means spread the money around. It's eggs in baskets, it's common sense. But when you're spreading money around when you're investing, that means broadly 2 things. You need to spread your money around different kinds of assets, first of all. So shares and bonds and gilts, maybe a bit of property, some commodities, maybe at the minute, but lots of different kinds of things. The idea behind that is that one asset class might behave differently to another. And so if one is having a difficult time, maybe the other will balance it out a little bit. It rarely works that perfectly, but by spreading the money around, you should reduce the risk of one particular asset class going down and you losing significant amounts of money. The second way you diversify is geography. You spread your money around the world. Even though we're here in the UK, we are something like 8% of world stock markets by value. So there's a whole world of value out there, and in order to reduce risk, you need to make sure you're tapping that value across the world. The second way you reduce the impact of risk is time. And that simply means when you're investing, you should be investing for the longer term. The longer you invest for, the less the impact of short-term ups and downs. So as I record this in January 2016, markets are pretty rocky. But if you're investing for 20 years, what do you care? The longer you invest for, the less or the lower the impact of short-term market movements. So time in the market is a big factor in reducing risk. The third way to reduce risk is to review your portfolio. In other words, keep an eye on it. This should be done regularly, maybe annually or more often if you want. But if you've got your money nicely diversified and spread around, it may be that if you leave it to its own devices, it will drift and it will no longer be set up exactly how you planned it to. So you should review your portfolio regularly and rebalance it. Tidy it up back to your initial intentions. That way, you reduce the chances of it just drifting off over time and becoming a more risky portfolio as a result. So, 3 factors to reduce risk. Diversification, spread the money around. Time, hang in there for the long term. And then finally, review, keep an eye on it. Those 3 things will reduce the risk and reduce the chances of anything nasty happening to your portfolio. Thanks for watching, I'll see you next time.